Hey guys, now that we've looked at some terms, some problems in Chapter 6, let's just tie it all together. So we've looked at bank reconciliations, and I'm not going to bring that up again. I think we covered that well in the last 4 videos, and how important it is to reconcile book to bank. I think we've done a really good job on that. So I'm going to let you guys read these sections, make sure there's anything you need to pick up from. Now, when we write a check, there's 3 parts to that check, or 3 people involved with that check. We've got the maker, that's the person signing the check, the person that we're paying. So like say you're paying your utility bill, so you're making it out to the power company. So you sign it, you're the maker, pays the power company, and then the bank, or even the credit company, credit union, or whoever you're banking with, okay? There's 3 parties to a check. Internal control, and you might have heard me mention that. It's huge in accounting. Management, because I know some of you guys aren't accounting majors, right? Management, but you're business majors. Management is ultimately responsible for internal control. That's not accounting. Accounting can help you with it. Accounting can make sure the internal control procedures are followed through audits and let management know if they are or they aren't. And there's other things to what internal control can do, or internal audit can do for internal control, and same thing for external audit. But internal control is management's responsibilities, and it monitors, makes sure on an ongoing, consistent, real-time even basis that the rules that the management's put in place are being followed. And it really does help control and make sure business activities are correct. How does the CEO of Walmart know that when they say they had $1 billion in sales, that all those cashiers were doing what they're supposed to do? Or even people in the self-checkout lines were doing what they are supposed to do? Well, there's going to be some theft and stuff going on, obviously, but in general, how do they know it's accurate? I mean, they have to trust that the internal controls are being monitored and that there are good internal controls in place to guarantee that whatever number they say they had in sales, for example, was accurate or close to accurate or very, very reliable, very, very accurate. So they protect assets, inventory, sales, the inventory leases, sales, buildings, cars, whatever it is, ensures reliable accounting like sales, efficient operations, good decision making, right? The numbers are accurate and there's good decision making, so efficient operations, and upholds company policies. It's so important. Internal controls are so important that large companies, and I'll spare you the details on what an accredited size firm is, but a company with stockholders, a larger company with stockholders, is required by SOX, S-O-X, or Sarbanes-Oxley, to not only have an external audit, but also have an external audit that reviews their internal controls. So they have an ICFR, internal controls over financial reporting. So not every company has to do that, just your larger accredited companies. And what they're looking at is guaranteeing that they have effective internal controls. External auditors must evaluate that. It could be the same company that looks at the books, like the balance sheet, income statement, cash flow statement. Violators receive harsh penalties. I mean, if the president, CEO, CFO, financial officer, chief financial officer says, yeah, internal controls are great, and they're awful. I mean, I just don't think they made a whoopsie. Not a whoopsie. They're not going to jail for whoops, missed that. Oh my goodness, let's fix that. Nothing like that. I mean, I'm talking just I don't know the words. I'm not a lawyer. So I'm thinking it would be more like negligent, like just a blatant disregard for trying to do a good job in this area. I think it's, you just can't have an honest mistake, right? Anyway, and then Public Company Accounting Oversight Board oversees SOX, or the ICFR. All right, so fraud triangle. People commit fraud. More than likely, it's caught with whistleblowing. That is the number one source of catching fraud. So if you've heard of whistleblowing before, one of the benefits is catching fraud. The second one is evaluating internal controls. The second most effective way of catching and preventing fraud is internal controls. All right, and there it is: opportunity, incentive, and rationalization. Some argue that this needs to be modified and updated. I think if you were to be in business world long enough, I think in the next 10 years this might be modified slightly. Opportunity, incentive, rationalization might be called capability, or it might be the fraud square. Some people propose that, or different shapes. Maybe there's more than 3 parts. All right, so cash and cash equivalents. Cash obviously is cash, and then a financial instrument with an original maturity of 90 days. I'm telling you guys, that's what FASB, we've talked about that, Financial Accounting Standards Board, that's the definition. 90 days or less is a cash equivalent. Petty cash, we've talked about that, that's pretty cool, and we've talked about bank recs, which is pretty cool. All right, so if you're familiar with these terms, and you know this outline, I think that'll go a long ways to helping you on exam that's coming up. All right, I think you'll be on exam 3, module 3 exam, all right, which is going to be comprised of chapters 6, 7, and 8. Thank you. If you have any questions, email me.